If you're even thinking about buying a home in Florida right now, you need to pay attention, because what you're about to hear could easily be the difference between protecting your capital and walking straight into a six-figure financial mistake. Florida is flashing red warning lights, not headlines, not hype, real numbers. Insurance costs are exploding, property taxes are climbing fast, inventory is building in key markets, and data already shows several Florida cities lining up for major price corrections in 2026. Most buyers are still pretending it's business as usual. It's not. So here's exactly what we're doing in this video. We're breaking down 10 specific Florida cities where home prices are positioned to fall hardest in 2026. We'll walk through what went wrong, what's already happening, and why the next phase will be brutal if you buy blind. Real data, real pressure points, real risk. Florida has been the dream for years. Sunshine, no state income tax, affordable homes compared to New York or California. From 2020 onward, that dream turned into a frenzy. Prices surged, inventory vanished, sellers dictated everything. But that wave is flattening, net migration is slowing, the insurance crisis is turning from problem to disaster. Families are realizing Florida is no longer cheap, especially once you add premiums, taxes, and fees. In many zip codes, homeowners insurance has doubled or tripled. Some carriers have pulled out altogether. Others are pricing policies so high that normal middle-class buyers simply tap out. And when buyers can't afford to insure, they don't buy. When they don't buy, prices don't just cool, they drop. Layer on aggressive property tax reassessments, HOA fee hikes, flood risk, and new zoning chart flood maps, hurricane exposure, and you got the perfect setup for a statewide reality check. Let's go city by city. Number 10, Cape Coral. Cape Coral used to be the poster child of Florida's boom. Endless canals, waterfront homes, palm trees, and a price tag that seemed like a discount compared to Miami or Naples. During the pandemic, it became a magnet. Retirees escaping northern winters, families seeking space, investors chasing appreciation and rental yields. On the surface, it was paradise at a discount. But the very thing that made Cape Coral attractive, the canal system and water access, is now its biggest liability. Over 400 miles of canals means more flood exposure, more storm surge, risk, more damage when hurricane seasons hit hard. Recent storms, rising water levels, and repeated flood claims have pushed the insurance system over the edge. In real terms, some homeowners are now paying more annually for insurance than for their mortgage. Five-figure premiums, $10,000+ a year, are becoming far too common. Some owners can't even find coverage at all as major insurers retreat from Southwest Florida. Meanwhile, median home prices, which popped over the $400,000 mark at the peak, are sliding. Inventory has more than doubled compared to last year. Listings are sitting longer. Price cuts are becoming standard, not rare. Even cash buyers, usually the ones who keep a market afloat during stress, are hesitating. They're looking at long-term flood risk climate exposures, rising carrying costs, and realizing the math doesn't look good. Add environmental issues, recurring red tide, water quality concerns, and infrastructure struggling to keep pace with rapid population growth. Cape Coral's story is simple. It expanded too fast on speculative money and cheap credit. Now, rates are higher, insurance is painful, demand is fading. The beauty is still there. The lifestyle is still appealing. But in 2026, Cape Coral isn't a pure paradise buy. It's a high-risk correction market. Number 9, Naples. Naples has always been Florida's luxury trophy. Perfectly manicured streets, upscale shops, pristine beaches, and for years, a real estate market that looked bulletproof. During the boom, the median home price in Naples blew past the $1 million mark, driven by cash-heavy retirees, high-net-worth individuals, investors parking capital in hard assets. For a while, it felt invincible. Now it's bending. Prices are down roughly 12% year over year. Luxury condos that once sold out before completion are sitting for months. Waterfront estates are quietly taking six-figure price cuts just to get attention. And the real pain isn't just the price tag, it's the cost of holding. Insurance premiums in coastal Collier County have more than doubled since 2022. Some policies now run $20,000, $25,000 pluses per year. Property taxes and HOA fees are punishing anyone who bought at the top expecting stable appreciation. Even wealthy households eventually ask, does this still make financial sense? Meanwhile, the wave of out-of-state buyers has slowed. High rates are thinning the pool of affluent buyers. The rental market, once a safety net, has softened, pushing some owners into lower rents or negative cash flow. Naples is not over long-term. Beauty, lifestyle, and scarcity of land will always support some level of demand. But the belief that Naples only goes one direction, up, is dead. The luxury bubble is deflating and the correction isn't over. Number 8, Jacksonville. Jacksonville was a major winner in the remote work era. Bigger homes, coastal access, lower prices than South Florida, plus real jobs in logistics, healthcare, finance, and defense. It looked like the perfect new era hybrid, big enough to matter, cheap enough to feel like a steal. But in 2025, the cracks are visible. Active listings are up 80% plus compared to a year ago. Prices have reversed, with declines in the ballpark of 10 to 12%. Neighborhoods that were roaring, Riverside, San Marco, Nocatee, St. John's, are cooling hard. What's the pressure point? Affordability. Property taxes have crept up, insurance premiums have doubled in some zip codes, wages simply haven't kept pace with housing inflation. Families who moved in expecting cheap Florida are discovering a different reality, rising monthly costs and declining equity. Builders are also stuck. They built aggressively to meet pandemic demand. Now they're sitting on standing inventory. Incentives, mortgage rate buydowns, and price cuts are back on the table. Jacksonville still has a strong economic foundation. But the housing market overshot. The result is a multi-year correction phase, not a quick dip. Going into 2026, buying blindly in Jacksonville means pretending those costs and supply pressures don't exist. Number 7, Lakeland. Lakeland used to be Central Florida's smart play, perfectly placed between Tampa and Orlando, commute options in both directions, and for years, significantly cheaper housing. That edge is fading fast. Home prices are up more than 50% since 2020. Median home values around $350,000 and beyond are colliding with local incomes near $65,000. That mismatch is brutal. Many locals simply can't afford to buy. Many renters who wanted to buy are now stuck. Demand is softening, not because people don't want homes, but because the math has broken. On top of that, Lakeland is dealing with congested roads, overstretched schools, limited public transit. The easy living, easy commute pitch has turned into daily frustration for a lot of residents. And while Lakeland isn't coastal, it's far from immune to weather. Heavy rains and runoff from surrounding lakes are driving flood-related claims. Insurers are reacting with higher premiums and tighter restrictions. Investors who piled in during the boom are quietly backing out. Margins have shrunk. Rents are not scaling in step with costs. Many flip or short-term play homes are back on the market. Supply is rising, demand is cooling, affordability is gone. Lakeland is still well located, it still has charm. But the narrative has changed from undervalued to overheated. Number 6, Port St. Lucie. Port St. Lucie used to be the quiet Treasure Coast move. Clean neighborhoods, wide streets, newer construction, plenty of room for families, and for a long time, a price tag that felt reasonable compared to Palm Beach and Miami. Then the pandemic hit. Remote workers came. Families relocated from South Florida. Investors chased next market up appreciation. The problem is what came after. By 2025, new construction surged past demand. Rows of unsold and half-finished homes are now scattered across St. Lucie County. Builders are offering discounts, upgrades, and creative financing just to move units. Home prices are already down close to 10% from their peak, and inventory is at a decade high. Meanwhile, HOA fees are increasing. Insurance for a basic single-family home can easily hit $5,000, $6,000 a year. More in flood zones. Job growth has stabilized, but not enough to justify previous price jumps. Some buyers who closed during the frenzy of 2021 or 2022 are already underwater. Investors are finding it harder to cover expenses with rent as the rental market softens. Port St. Lucie is not a disaster zone yet, but if inventory continues to rise and affordability continues to erode, the correction will deepen going into 2026. Number 5, Fort Myers. Fort Myers is a classic Florida postcard: palm-lined streets, waterfront neighborhoods, boat life, Gulf sunsets. But it's also a case study in what happens when a beautiful coastal market gets hit with severe climate events and an insurance system that can't keep up. Hurricane Ian was the turning point. Thousands of homes destroyed or heavily damaged. Rebuilding slowed by material costs and labor shortages. Bureaucratic delays, insurance battles, and uneven recovery. Years later, the wounds are still visible. Overlay that with insurance premiums that have more than doubled in many neighborhoods. Flood-prone areas seeing annual premiums in the $10,000, $20,000 plus range, if coverage is even available. Several major insurers effectively stepping away from the area. Home prices are down around 15% from their peak, and the market is fragile. Buyers are cautious, lenders are stricter, sellers who bought at the top are trapped between loss and stagnation. Some neighborhoods are bouncing back with fresh construction and improvements. Others are stuck waiting on payouts, approvals, and clarity. The bigger issue? Retirees once saw Fort Myers as an affordable Gulf Coast haven. Many are now reconsidering due to cost of ownership and repeated climate shocks. Fort Myers will always have lifestyle appeal, but between 2024 and 2026, it's in a long recovery phase, both physically and financially. Buying now without factoring in insurance and long-term risk is not investing, it's gambling. Number 4, Ocala. Ocala used to be the quiet, underrated play. Horse country, rolling hills, retirement communities, land for less money than the coasts. Affordability was the brand. That brand is under pressure. By 2025, home prices in Marion County have slipped nearly 8% year over year. New subdivisions that once sold out off-plan now sit half empty. Builders are cutting prices, covering closing costs, and throwing in extras. The shift from seller's market to buyer's market is obvious, but buyers are not rushing in. Why? Because cost of living has jumped. Insurance premiums are up, property taxes are up, utilities and energy costs have climbed with inflation. For retirees on fixed incomes, that matters a lot. Many are recalculating. Can I stretch my retirement further in another state? Tennessee, the Carolinas, and other inland markets are starting to look more attractive. Meanwhile, growth outside key sectors, healthcare, logistics, isn't strong enough to support runaway housing costs. The wave of out-of-state buyers that drove the boom has thinned. Ocala isn't collapsing, but the cheap hidden gem story is over. Now it's a market that needs time to find a new equilibrium. Number 3, Punta Garda. Punta Garda is visually stunning. Sailboats, harbors, colored homes, slow-paced, upscale coastal living. But under that beauty is a structural problem. It's in one of the most hurricane-prone corridors of Florida. For years, the waterfront lifestyle overshadowed the risk. Now the risk is dominating the financial reality. Insurance costs have exploded. Some homeowners are paying $15,000 a year just to insure their properties. Others can't find new policies at all as carriers pull back. Without affordable insurance, buyers walk away, lenders hesitate, sales stall. Prices have already taken a noticeable hit. Double-digit declines in multiple neighborhoods since 2023. Retirees, the core buyer base, are quietly exiting for safer, cheaper inland markets. Younger buyers look at the insurance plus mortgage combo and simply can't justify it. Developers who saw Punta Gorda as the next big coastal play are now pulling back. Vacant lots and shelved plans are becoming more common along the water. The lifestyle is still there. The views are still there. But you cannot ignore the financial math. Unless insurance reforms or serious resilience measures change the equation, Punta Gorda is positioned for continued pressure into 2026. Number 2, Tampa. Tampa's boom was massive. In 5 years, it went from undervalued Gulf market to national hotspot. Revitalized downtown booming suburbs. Tech, finance, medical, and logistics growth. one of the fastest appreciating markets in the country. Prices didn't just rise, they exploded. Median home prices pushing above $450,000. Median household incomes near $70,000. That gap is not sustainable. For a while, cheap rates and investor demand papered over the problem. Now, insurance premiums, especially near water, are hitting $15,000, $20,000 a year in some cases. Property taxes have ratcheted up based on inflated boom-era valuations. Everyday living costs, gas, groceries, childcare, have followed suit. Middle-income families are getting squeezed out, the very people who are supposed to anchor a city long-term. Investors who once ate up entire neighborhoods are facing higher rates, softer rents, and slimmer yields. Some are starting to liquidate. That adds more supply at the exact time organic local demand is weakening. Result, more inventory, fewer qualified buyers, downward pressure on prices, especially in overbought suburbs and investor-heavy pockets. Tampa still has real economic muscle, but the housing market is moving from wild expansion to rough equilibrium. In 2026, this market won't be defined by frenzied bidding, wars. It'll be defined by buyers and sellers waking up to reality. Number one, Miami. Miami is Florida's crown jewel and its biggest risk. For decades, it seemed like the rules didn't apply. International money, hedge funds, celebrities, high-end developers. Every time someone called a top, Miami shrugged and pushed higher, beachfront homes tripled, condos sold out years before construction, global crises came and went, and Miami stayed hot. But in 2025, the gravity is finally kicking in. Median home prices in some segments are down around 15% from recent peaks. Condos are sitting on the market longer. International demand, from Latin America, Europe, and elsewhere, has cooled. Why? Global economies have tightened, stricter money flows and regulations, and increasingly climate risk. Sea level rise, stronger storms, and new flood maps are no longer theoretical. Insurance for coastal and near-coastal homes is exploding. Some owners pay more in premiums than in mortgage payments. Others are pushed into expensive last-resort state-backed insurance. Developers are still building glass towers, but the pool of ready, eager, all-cash foreign buyers isn't infinite. At the same time, local residents are priced out by both ownership and rent. Many essential workers can't afford to live anywhere near the core. Miami's economy, tourism, finance, crypto, tech hype still has momentum. But the housing market is now heavily exposed to shifts in global capital insurance realities, climate perception. The correction that started quietly in 2024 is spreading. Miami isn't going to vanish, but the idea that it can defy economics forever is over. Final recap. The 10 Florida markets to watch closely. These are the 10 Florida cities most exposed to hard corrections going into 2026. Cape Coral, Naples, Jacksonville, Lakeland, Port, St. Lucie Fort, Myers, Ocala, Punta, Gorda, Tampa, Miami. Every one of them shares the same pattern. Rapid price growth, underestimated risk, rising cost of ownership. Slowing demand. Florida is not finished, but the old script is dead. You can still make smart moves, you can still find opportunity, but you cannot afford to be naive. Before you buy, get actual insurance quotes, not estimates. Run full monthly cost projections, mortgage, taxes, insurance, HOA, maintenance. Look at inventory trends, not just last year's appreciation. Understand flood zones, storm history, and how insurers are reacting. In this cycle, timing and location aren't just important, they're everything. If you get them wrong, Florida will punish you. If you get them right, you can position yourself for serious opportunity after the correction clears. The choice is simple. Chase the dream blindly, or read the data and move like a strategist.